the second wave of the Great Inflation, 1976 to 1980. Ed, welcome.
Thank you, John. Well, thank you very much, John, and thank you to both Johns and to Michael for inviting me to this conference. It's a great honor to be able to speak tonight, but it's also been a fabulous opportunity to attend and experience these very absorbing sets of panels, and it's been a great experience for me. And I'm delighted also to be given the honor of speaking at a conference about the Hoover Institution, or at the Hoover Institution, the conference that has Hoover in its title, and the fact that I've been asked that my talk at a Hoover Institution conference be on Milton Friedman is very poignant for me. John was asking me, as we were prepping just now, when was the first time I went to the Hoover Institution? And actually that's a very germane question, because this occasion takes me back to the first time I ever set foot here, which is during a day visit I made just on my own bat, well over 30 years ago. And I actually have a photograph of that occasion here. In my remarks tonight, I'll be drawing on a book manuscript, a complete draft of which is available online. These are just mock-up covers, but I have no problem getting photographic rights for these covers because I took the photograph, and so these these covers sort of poignant because it's Milton Friedman staring at me and, in a sense, asking me to get it right, I suppose. It's a continuation of a previous two-volume study that has been published, Milton Friedman and Economic Debate in the United States, 1932 to 1972, and I should mention that a great many of the people in this audience were very kind to me over the years in giving interviews, in giving materials they had, and being generous on that score, and in providing endorsements for the published version of the book. That I got compliments on the endorsements, and so from Emmy's endorsement in particular, a number of people have said how much they liked that endorsement. And the continuation, both the continuation book and the original book, the onset of this project, the inclusion of the word economic or economics, was essential because it reflects the fact that the book's focus on Milton Friedman's economic framework, how he applied it in his contributions to debates on research and public policy forums, as well as the fact that the account is written from my perspective, which is the perspective of someone in Friedman's own research field of monetary analysis and macroeconomics. The volumes that have been published, these ones they consider the pre-monetarist years of Friedman's activity in economics, the changes in his thinking and the impetus for those changes that turned him into a monetarist, the details of his economic framework and his engagement in research and policy debates during the first 22 years of 1951 onward, as his first 22 years as a monetarist. The volumes conclude just before the inflation breakout of early 1973, and the continuation volume covers the rest of his life from 1973 to 2006. And these later volumes, like the earlier volumes, cover Friedman's research contributions and his interventions in the public square. For example, his media contributions in his books co-authored with Rose Friedman. In the post-1973 volumes, the public policy activity absorbs an increased proportion of the coverage as Friedman concentrated in this period on public policy rather than research. In addition, the continuation volumes predominantly concern his years at the Hoover Institution. And tonight I will focus on a single item in Friedman's public policy activity, his prediction and analysis of the second wave of the United States Great Inflation, which I define as the rise in the inflation rate from its 4.8% December 1976 trough, a rise that culminated in double-digit inflation rates in 1979, 1980, and 1981. This aspect of Friedman's public policy activity spanned the period surrounding his move to California and the Hoover Institution. The account that I'll give tonight will not primarily involve considering his research. It's really about Friedman's statements on inflation that appeared in non-research outlets, but of course they reflect the monetary framework established in his research, including the body of work produced with Anna Schwartz. And a look at this episode will shed light on how his viewpoint contrasted with, but helped reshape thinking in policy circles and the economics profession during the late 1970s and lead up to the bulk of disinflation. Well, what do I mean by the second wave of the great inflation? This is the answer that is highlighted by this figure. The US economy had so-called twin peaks of inflation during the great inflation of the 1970s, with double-digit rates recorded in the mid-decade and the period of 1979 and the early 1980s. The second wave of the great inflation featured the second of the twin peaks and will be my concern tonight. Now, I should mention that over the years, there's been skepticism expressed about how genuine that second peak was. In particular, the fact that CPI was pushed up by the second oil shock and by the statistical treatment at the time of mortgage costs that has been used as a basis for doubting whether the second period had double-digit inflation that could be attributed to the creation of excess demand. And the peak of CPI inflation in 1980 was undoubtedly boosted by special factors, but the PCE inflation rate also had a double-digit peak. The GDP inflation rate likewise reached double digits in the early 1980s, as you can see. And the notion that wave 2 of the great inflation was at least as severe as wave 1 is reinforced by considering the 4-year average of a series that was considerably focused on at the time, which is the GNP deflator inflation rate. And this average is higher, actually, this 4-year moving average is higher in the early 80s than it is in the mid-70s. And so the case for viewing the second wave as being at least as insidious as the first and as reflecting sustained forces put in place by aggregate demand policy seems quite sound. I should mention in my beginning I should have added the disclaimer that's very important for any Federal Reserve talk, and mine is especially important as I am even less able, at least the Reserve President is able to speak for his bank or his or her bank. I'm not able to speak for anybody but myself, and I don't pretend to in this talk. This is just my views. The second wave of the great inflation was unexpected. A Business Week article noted in March 1975, it is highly unlikely that double-digit inflation will recur in this decade. And testifying in 1981 about US budget forecasts that had been submitted at the end of 1977, a government official said nobody predicted the double-digit inflation that actually occurred in the 1979-80 timeframe. Those were not predicted to occur. This characterization neglected Milton Friedman's public interventions. And a friend of his was actually now deceased, but was one of the many people I interviewed for my books, actually wrote to the Wall Street Journal at the time and said, in your ongoing debate about econometric models, it was particularly disturbing to read Michael Evans, who was a well-known commercial econometrician at the time. His comment that no one correctly forecast inflation for 1978 and 1979. He's wrong, because Milton Friedman did. And Friedman did make a sequence of predictions from 1976 to 1978, initially forecasting the turnaround in inflation, and then indicating inflation would reach double digits, and then suggesting a peak in the 10 to 13% range. In the first half of December 1976, he stated that inflation would trough around February 1977. In the 12-month CPI inflation rate, the actual trough was 4.8% in December 1976, as I mentioned. In that December 1976 Friedman commentary, he also predicted a 7 to 9% average inflation rate over the February 77 to mid-79 period. On television in April 77, he said, I expect inflation is going to step up in the next year or two to 7 or 8%. Then the fall of 77, in the wake of double-digit M2 growth that was occurring during 1976, having continued in 1977, he predicted in his Newsweek column and in public talks that there would be a return of double-digit inflation in 1979 or 1980. And a Chicago Tribune report on one of these sets of remarks was titled 10% inflation in 1980, question mark. With regard to 1978 specifically, Friedman, in a briefing to a financial firm in October 1977, stated that he saw 1978 inflation as being 7 to 10%. This was when US economists' consensus forecast was 6%. And in his Newsweek column in April 1978, he gave the average inflation rate likely to be seen in retrospect as having prevailed from February 77 to October 79 as being 7 to 10. And he went on to remark during a mid-1978 briefing, it would be a miracle if inflation peaked below 10%, and 10 to 12% or 10 to 13% would be more likely. He assessed that peak as likely to occur in 1979 Q4, and like his other predictions in this period, 76 to 78, this closely matched actual outcomes. The peak occurred in 1980 Q1. Now, in making these predictions, Friedman was again marking himself out from mainstream macroeconomic opinion. In fact, in the second half of the 1970s, Friedman's views on inflation, not just in their focus on monetary growth, but also in their tracing the decade's inflation to aggregate demand developments, was still encouraging strong resistance. This was, I should emphasize, notwithstanding his recent Nobel Prize in economics. The resistance in practical policy-oriented circles and discussions to his views on inflation actually went up a bit in the years 1977 and 1978. And during these years, he was very much out of step with policymakers and many economists in the perspective that he took on the analysis and control on inflation. And the contrast is brought out by real-time statements by people in various government positions within the US government in 1977. Across government agencies, there was agreement that very large resource lack existed. Alice Rivlin, the CBO director, suggested with excess capacity and high unemployment continuing, demand pressures do not seem likely to lead to an acceleration of inflation. Stimulus to get the rate of real growth up to 5 or 6% would probably not add greatly to the problem of inflation. In the new Carter administration, brand new economic officials Bert Lance and Charles Schultz wrote in a joint statement in January 1977 that the overwhelming majority of serious macroeconomists have called for expansionary economic policies, and Schultz said the following September, ample resources are available to permit further expansion. And although they were not as active in actually campaigning for expansion, Federal Reserve policymakers, including Arthur Burns, expressed similar judgments about the output gap. And as of the first quarter of 1977, the reported US output gap estimate stood at about 9%. This was severely overestimated slack, as Athanasios Orphanides and co-authors' research would document. Also, slack was rapidly diminishing in 1977. And one thing about Friedman is that we all know that he was a pioneer on the natural rate concept, as people were talking about in this afternoon's sessions in particular. But he didn't present his own estimates of the output gap. He emphasized the fragility of outstanding estimates, notably those of U-star, and he eschewed the usage of them in his own analysis of ongoing US economic developments. And there was some skepticism about Friedman's public commentary on inflation, with James Tobin criticizing a Friedman column that appeared in October 77 on the grounds that it took an extreme view of there being zero slack. His column actually is not quite as overt on that point as Tobin was suggesting, but in any event, whether Friedman had that view or not, it ultimately became the mainstream. The CBO now sees US output as crossing US potential GDP growth around 1977 Q3. And although Friedman's prescriptions and his analysis in this period were consistent with an augmented Phillips curve framework, he relied principally in his quantitative analysis on reduced form linkages between nominal series, notably monetary growth, nominal income growth, and inflation. This approach led him to believe that in late 1976 there was already considerable stimulus in the pipeline and that monetary policy settings should become less, not more, expansionary. In a nice column he wrote at the end of 1976, he offered the following prescription: take it easy, hold down government spending, hold down the rate of monetary growth, let the recovery proceed as it then would at a moderate pace. As the recovery proceeds, reduce the rate of monetary growth still further so that we can force down the rate of inflation gradually over a few years. This was not a widely shared prescription. In fact, in part, this reflects the fact that many other economists didn't see the first half of 1970s experience as an instance of monetary policy generating high inflation, or even of expectational Phillips curve dynamics in action. The Nobel Prize, which was sort of an omnibus for various Friedman and Friedman-Schwartz work, was was largely for work produced in the 1960s, and in many circles in the late 1970s, the Friedman-Phelps story was seen as mainly useful in understanding the decade of the 1960s. The 1970s inflation was seen as different, as being overwhelmingly cost-push. The cost-push perspective on inflation, as Friedman has often stressed, nothing new. It's also quite mechanical in the sense that it's an approach in which the behavior of inflation is traced as though adding up items in a spreadsheet to the behavior of particular cost and price categories, with these items in turn seen as having a life of their own rather than as depending on the aggregate demand, aggregate supply balance. And according to this mindset, the rise in inflation in 1976 was mainly attributable to autonomous forces, and the mid-decade rise in the unemployment rate, this is what you see here, that was seen as having had little to do with the 1975 and 76 disinflation, according to this largely this view that was prevailing largely in government. Alice Rivlin, for example, remarked in January 77, if we get double-digit inflation in the next year or so, it's much more likely to be from extraneous causes that have nothing to do with excess demand. We're not in an excess demand situation now. She added that the principal fact, the upper gap and its intended higher level of unemployment and excess capacity explain relatively little of this, that is the 75-76 reduction in inflation. She just saw as the ending of the effects of, she saw it largely in terms of the ending effects of one-time shocks that hit the economy in 1972 to 74. Likewise, in the Carter administration, the Treasury Secretary Blumenthal observed that much of the acceleration of inflation during the first half of this decade was due to such outside shocks as the higher energy price imposed by the OPEC countries and severe weather. And of course, although I won't get into them here, Arthur Burns and his successor, I talk about Bill Miller a bit, but Arthur Burns I'll leave to other documentation. He during his tenure made many statements along the same lines. And as I've already indicated, much ahead of the second wave of the Great Inflation, inflation troughed in the last full month of the Ford administration, that is December 1976. Furthermore, after its 1977 rise, the additional inflation surge in 78 and 79 largely occurred under Federal Reserve Chair G. William Miller, who was a President Carter nominee. But in contrast to accounts that associated the rise in inflation with the change in administration from Ford to Carter, or in the Federal Reserve leadership from Burns to Miller, Friedman attributed the second wave of the Great Inflation overwhelmingly to actions taken by the Burns Federal Reserve, which had presided over the 1970s second monetary explosion in 1976 and 1977, that is renewed double-digit growth rates of M2. There you see that here. This rapid monetary growth had taken place in the context of real federal funds rates that, after being negative in 1975, had been allowed to remain negative, and by a widening amount in 1977. You see this in this chart that appeared in Clara Gully and Gertler's 2000 paper. But although Friedman viewed high inflation in 1978 and 1979 as locked in by Burns' monetary policy actions, Friedman became critical of Miller too. Like others, he criticized the Miller Federal Reserve's monetary policy tightening, which certainly occurred. The monetary policy tightened under the Miller regime, but he thought it occurred in a too leisurely manner. And as I've already suggested, Miller had a cost-push outlook on inflation. And for example, in August 1978, Miller remarked the Federal Reserve has limited it to what it can do about inflation. And in January 1979, he wrote, our arsenal of weapons against inflation is somewhat restricted. And this outlook put Miller at odds with Friedman, and the difference between them was not on the need to disinflate, but on how much difference monetary policy tightening could make in this process. Miller, in May 1978, reacted to a Friedman commentary that had appeared in Newsweek by observing, Dr. Friedman asserts that we need a long-term program dedicated to eliminating inflation. I agree wholeheartedly, but the divergence with Friedman was brought out by Miller's next observation. Monetary policy has a critical role to play, but it cannot alone bear the whole burden of combating inflation. Friedman believed it was the Federal Reserve whose actions were decisive for the course of inflation, but he also criticized the Carter administration on inflation, largely because it articulated a non-monetary cost push in perspective very prominently. And he believed this This position on the part of the Carter administration hindered public appreciation of the demand restriction steps that would be needed to produce disinflation. And the administration, like Miller, viewed price stability as desirable, but it propounded a cost-push view of inflation. And Friedman, at times, expressed incredulity that, and for example, in April 1978, he said, "Secretary Blumenthal knows as well as you and I do that inflation does not come from trade unions." Nevertheless, the administration made clear that it indeed did view inflation in these and similar terms. That's one of the tricky things in reading Friedman in this time. He sometimes because the academic opinion was moving at a faster pace toward his sort of views than the government. He was sometimes very skeptical about official statements by the government on inflation, but the government was sincere in believing that inflation was should be viewed in cost-push terms. And for example, Chair Charles Schulz observed in March 1978, "We can't wring this inflation out of the economy through measures which promote unemployment and economic slack. Such policies have only a limited impact on the kind of inflation from which we suffer." And he reaffirmed this position right into 1979. So especially before 1979, the Carter administration diagnosed inflation in terms of special factors, rises in specific prices, those associated with exchange rate depreciation, especially in 1978, weather, notably in 1977 when there was a cold snap, rising world food prices in 1978, and then food plus oil in 1979. And throughout these years, it put much emphasis on wage push, on pressures on prices associated with pay demands of US labour unions. And the administration's non-monetary outlook toward inflation was reflected in its anti-inflation measures. These included a January 1977 call by President Carter for pre-notification of private sector price increases, an April 1977 Carter announcement of a set of measures intended to bring inflation to 4% by mid-1979, his attempt in February and April 1978 to revive the wage price guidelines of the 1960s, and the modification of this idea in October 1978 that included a proposed system of tax-based rewards for wage and price restraint. And the President conveyed his outlook in April 1978 when he said, "We will not solve inflation by increasing unemployment. We will not impose wage and price controls. We will work with measures that avoid both extremes." Now, in the face of such endurance of cost-push views, Friedman reiterated his criticism of them. He was a long-standing critic of wage-push ideas, and he would sum up his position in April 1981, saying, "To say that wages are a cause of inflation is somewhat like saying that wet streets are a cause of rain." Wage rises are a manifestation of inflation. In April 1978, he observed that the most recent Carter package was like Hamlet without the Prince of Denmark. Inflation is not caused by trade unions, business interests, consumers, or oil. It has been around 1,000 years, and in all that period, only one medicine to cure inflation has been found: to hold down the rate of monetary growth and hold down governmental spending. And on television, Friedman appeared on Meet the Press numerous times, and he appeared on Meet the Press in November 1978. And he said, "The great confusion in this area is to confuse particular prices with prices in general. Why is it that people point to food prices as a cause of inflation, but I've seen nobody point to the sharp decline in the cost of computers or handheld computers, meaning pocket calculators, or computing services? Has somebody been pointing to that as a cause of deflation?" And of course they weren't, but the logic in that critique is very valid. And in 1979, in drafting the Free to Choose book, Milton and Rose Friedman titled their final chapter, "The Tide is Turning." This referred principally to public opinion on the role of government, but 1979 proved to be a tidal year also regarding views in policy circles on the causes and control of inflation, going in the direction that John Williams was talking about this afternoon, with this change in views rapidly reflected in policy stance. And the 1987 economic report of the President, largely drafted by Rich Clarida and Michael Musa, noted that the late 1970s cyclical expansion ended in a double crescendo of rising inflation and interest rates and falling economic activity. As this process was unfolding, Friedman wrote in his Newsweek column in August 1979, "The problem is not, as President Carter asserts, a lack of confidence. The problem is rather that the public is very confident that the government will produce inflation and will mismanage the economy. We do not need more confidence in bad policies, we need better policies. And by the time Friedman was writing these words, major changes were afoot in policy making and in general thinking about inflation in the economic profession. Far-reaching revisions in early 1979 to official output gap estimates made it easier to see the decade's great inflation, including the ongoing second wave, as due to excess demand. And in policy making, Paul Volcker became Federal Reserve Chair in July 1979 and viewed inflation as monetary in nature. And there were then and remain many divergences between Friedman's prescriptions and the monetary policy of the Volcker Federal Reserve, but a lasting convergence occurred in official thinking in 1979 toward Friedman's position that monetary policy had special responsibility for controlling inflation. This change would be clear in a nice statement that Volcker made in a congressional hearing in August 1983 when he said, "We have to be particularly sensitive to inflation. That is a monetary phenomenon. That's more directly in our bailiwick." And with regard to the second wave of the great inflation, remember, Volcker was vice chair of the FOMC in the second half of the 1970s. He wasn't somebody coming in, brought in from outside in 1979. He was in on a lot of the faulty earlier decisions. And he articulated a retrospective judgment that lined up with Friedman's. He appeared alongside Anna Schwartz in 1982 in an event in New York, and he gave a negative verdict on monetary policy in 1976 and 1977. So he said, I'll conclude with his words, Volcker observed that in the United States, non-inflationary economic expansion went on in the early 60s, and then the Vietnam War came along and all the rest. But we did have a 5-year period where that happened, that is non-inflationary expansion. It began to happen again, in my judgment, in 75 and 76, coming out of the recession. And then, for a variety of reasons, we blew it. So that is, I think, a good example in which Friedman's views on inflation did very dramatically become manifest in policy strategy, in the view of monetary policy responsibility for inflation, which was a very important aspect of the policy changes that occurred under Volcker and that have stayed since then. Thank you very much.
Hey, Ed, that was really great, but there's one thing I wanted to ask you about. So the St. Louis Fed was around in that time, and they were the monetarist reserve bank, right? And they were pushing Friedman's agenda all the way from the 60s. So like in your research at the FOMC, I mean, how did what the St. Louis Fed was saying and Roos, and I forget who the other guy was before him, but how much traction did they have in the debate? Because in a sense, you give the impression that the Fed's this monolithic institution and they just got it wrong. But here you've got this one reserve bank, and Jim Bullard's the successor of this way of thinking. Okay, and they called it.
Well, I think that I discussed this a bit in actually the published volumes, because I have a section on the St. Louis Fed, and I think there was a very important low-frequency influence on policy making on the part of the St. Louis Fed that was kind of seen in a resident critic stance, really, and so it's perfectly consistent to say that there were voices that were articulating much more orthodox, what we can now consider orthodox views of inflation, but they weren't the consensus. Noting the consensus is not the same as unanimity. There wasn't unanimity in the Federal Reserve system or in Federal Reserve policymakers on non-monetary views of inflation, but it prevailed at the leadership level. And Paul Volcker was an interesting case of somebody who was at the leadership level who changed his view about inflation. But the St. Louis Fed was certainly made a very useful contribution by, keeping the ideas going, keeping the critique going, being sort of, this is your work with with Ned Prescott emphasises the Reserve banks have been a very vibrant source of ideas in the Federal Reserve System and an influence, a forward-looking, a leading indicator sometimes of trends in the Federal Reserve. And I'm happy to say that in the Federal Reserve, I've worked both at the St. Louis Fed and at the board, so I've seen both sides of this nice arrangement.
I wanted to ask you about one specific set of mechanisms. Arthur Burns, in famous remarks, was extremely skeptical about the ability of the central bank to affect inflation expectations. He basically viewed it as things that were completely beyond the control of the central bank. By the time that Volcker came in, he was beginning to discuss how policy could affect expectations. Miller, I don't know. I haven't read statements by Miller about expectations per se. But one vision then would be that the 70s was a period in which the central bank largely took expectations as given and chose policy. And the later period was one in which there was a move toward managing expectations. And if we think about the kind of model that Amy Nakamura was talking about earlier today, where you have a kind of a flat Phillips curve, if you're a central bank and you think expectations are beyond your control and there are relative price shocks that are important, you might behave a lot like the way you're describing the Burns and Miller regime.
I agree that a flat Phillips curve defined as a low output gap elasticity gets you in the direction of having a lot of, let's say, short-term looseness in the relationship between monetary policy actions and inflation. But there is still a discontinuity at zero, and the non-monetary view of inflation is essentially saying that the output gap elasticity is zero. If you have a low output gap elasticity, you still ultimately control inflation through aggregate demand, not just through monetary policy. But one thing I'll say about the issue of the expectations term, inflation expectations, that really dovetails well with the notion, what you described, the contrast in views between Burns and Volcker. Dovetails well with the notion that Burns had a non-monetary view of inflation in which basically inflation is an autonomous process and expectations of inflation are likewise an autonomous process. And so they could happily concede or actively assert that inflation expectations were very important in inflation and not see that in terms of a Phillips curve mechanism or anything like that. So Burns thought of both inflation and inflation expectations, I would say, as given from the point of view of monetary policy. Whereas Volcker saw them both as endogenous with respect to monetary policy, and that's really going from a non-monetary view of inflation to a monetary view of inflation. Burns, one of the most egregious instances in which Burns obviously saw expectations of inflation as important, but was not really seeing them in terms of monetary policy's effect on them, was when the Nixon wage price controls were imposed in 1971. Because he said, okay, these wage price controls have lowered inflation expectations, therefore we don't need to have nominal interest rates as high as they used to be for any given real interest rate. So that is really taking the expected inflation term as external variable to monetary policy and leading to a worse monetary policy than you would have if you hadn't.
Hi, thanks. So this question, I think, dovetails with the last one. So if you go back to the mid-'70s and you look at the Green Book, there's very little discussion of inflation expectations. There are no measures of inflation expectation. And by contrast, today, there's, I think, on average, 40-some references to inflation expectations in every meeting, in the transcripts, and there's many measures of inflation expectation. So I guess I was wondering if Milton Friedman had the measures that we have today of inflation expectations, to what degree would that be a substitute for focusing on lagged nominal variables like M2 growth? because it's a nominal variable. It's just forward-looking as opposed to lagging.
Well, any answer is going to be speculative, but I think, Brian, one thing that is consistent with that, the notion that he would be very receptive to looking at and analysing inflation in those terms is that he wrote a little piece, I think in 1984, in the JPE, when he was frustrated at the Treasury after expressing interest in the early 70s under George Shultz in indexed securities markets, was sort of dragging its feet on indexed securities markets, and they'd been introduced in the UK. And he was saying one advantage of an indexed bond market is you'll have long-term, you'll have a self-contained measure of long-term inflation expectations coming from financial markets. And so that obviously was a very astute statement and underlies a lot of what people do today. And so I think that he would be receptive to that general direction of looking at things. Thank you.